Hello and welcome to Rajya Sabha Television. You're watching a special edition of Policy Watch with me, Frank Pereira. India is set to once again emerge as the fastest growing economy in the world. The United Nations earlier this month put out a report saying the country's economy is expected to grow at 7.2% in 2018 and 7.4% in 2019. This growth rate still falls short of the government's expectations of 8%, but it may still help India win the fastest growing economy title from China. India had lost the fastest growing tag in early 2017 after Prime Minister Narendra Modi scrapped old 500 and 1000 rupees currency notes, bringing cash-based economic activities to a halt. Even before the Indian economy could recover from the woes of note ban, the government rolled out the biggest tax reform, GST. It further aggravated the economic activities, bringing down the growth to the lowest of 5.7% in the last 13 quarters. However, in July-September quarter, India gained marginal recovery and recorded 6.3% GDP. On this edition of Policy Watch, we will take a look at the hits and misses in the Indian economy in 2017. Joining me on the program today are Dr. Arvind Virmani, former Chief Economic Advisor to the Government of India, TK Arun, Editor, Opinion, The Economic Times, and Ajit Ranade, Chief Economist, Aditya Birla Group. Thank you to all my guests for joining me on this edition of Policy Watch. Dr. Virmani, I'd like to begin with you, of course, and let's talk about the hits as far as the economy is concerned in 2017. What were they for you?
Well, I think constitutional approval of the GST and its implementation was definitely one of the major hits. Of course, there's a negative side we can discuss. And the second one was the bankruptcy law. If I remember, it was within this year, may have been 1 month this side, that side. But the bankruptcy law actually was a missed opportunity of the previous government, which they could have included in the corporate tax reform, but didn't. And we can discuss that either way. But I think these two elements will have great long-term positive consequences.
Sure. Ajit Ranade, as far as the corporate sector, as far as the industrial sector is concerned, what were the hits for the year 2017?
Well, inflation has been low. So from the economic point of view, for the country as a whole, achieving low inflation during this year was, I would say, a hit. The corporate sector, of course, has been very happy with the fact that the stock market, which is market capitalization, is very high. In fact, the stock market indices reached new peaks. The bond market, the corporate bond market, also achieved new historic records. I think even the foreign participation in the corporate bond market, I mean the non-government bond, that is private corporate bond market, was very high. Increasingly, we are trying to get a mix of both bond and bank financing. So to that extent, it's a good sign. And of course, to add to what Dr. Virmani said, I think not only was the GST passage constitutional, which was last year actually, but its implementation this year, but also the very good record on disinvestment. After a long time, the government was able to not only achieve but exceed its target of disinvestment in a very meaningful way. That also I would count as a big hit, not just for the government but also for the corporate sector, which got to invest in those disinvestment offerings.
Sure. TK Arun, from your point of view, someone who's been watching the economy very closely from Delhi, what were your takeaways this year?
There are some things which came from outside the government's initiative. For example, India today is one of the largest and fastest growing users of data through a mobile broadband network. This actually is a presage to great things that could happen in the Indian economy as nearly 1 billion people become empowered through communications and capable of digital production and transaction. At the same time, we continue to be very low on investment. Investment as a proportion of GDP is at a 27% of GDP, which is more than 10 percentage points below the peak we achieved in 2007-8. And this is actually what is holding growth back. India will continue to probably straggle along at this 7.5% growth rate till we are able to pick up this investment to GDP ratio. And that can happen once the bank's non-performing asset problem is resolved. And we move to a new system of funding infrastructure projects. See, it is not viable for banks to lend infrastructure projects the way they did in the past and ended up with the current mess in which they find themselves now. So what should be the new way of financing infrastructure? These are the issues that need to be tackled. And while the government has promised recapitalization of banks, there is as yet no clarity on what are the reforms that will ensure that the recapitalized banks behave better and lend in a more sound, fiscally prudent fashion. Demonetization has had a very serious and continuing effect on the economy. I don't think the impact has been completely removed. GST, it was probably a mistake to have rolled it out in July itself. You finalize the rules on the 30th of June and the next day you want to implement GST. Most countries in the world that implement GST or a tax like that had at least 6 months.
So it should have been better planned is what you're suggesting.
Better planned, and people should have had the time to prepare for a GST to understand what it's like.
But there was a constitutional deadline that the government had to deal with as well. So
that was in September.
That was in September. So you're saying it would have been better if it was rolled out in September?
Yes, we could have used that cushion of time better. Anyway, it is a great thing that we actually launched this tax, and the government has shown willingness to resolve the glitches, and nobody had expected this tax to roll out without any problem. So this will be resolved and we'll move ahead. But the only thing is, an economy is not just about the macro numbers. It is also about overall political stability, and in that, internal peace and harmony of the society is also an issue.
Sure.
On that, there has been serious shortcomings in the last 1 year.
Right. Dr. Virmani, going forward now, TK Arun raised a couple of very pertinent points about the NPAs and strengthening of banks. The finance minister has said that the focus of the government in 2018 is going to be on strengthening the banks. Do you believe that, the NPA problem is going to be resolved in 2018? Some steps have been taken by the government this year.
So, within the two positive things which I mentioned and the third one which I would like to talk about, each has difficulties. One, the GST, clearly the design both in terms of structure and in terms of the bureaucratic thing was driven, in my view, too much by the politicians who are represented on the 29-member GST council and the bureaucrats who implemented it. I think there was too little input, relatively speaking, from economists who actually have been studying this darn thing, if I may say so, for 20 years. But okay, so that I think was a miss in a way. I wish they had recognized this earlier, but they are beginning to recognize it, so I'm hopeful for 2018. The second one on bankruptcy, clearly many of the ills that people are now blaming on the implementation of bankruptcy, and many of the institutions who actually thwarted this process for 20 years, for example, the judicial system, which always favored the lenders, now suddenly have become very moralistic and blaming everything on others. But I remember, I have been around for 30 years. So there are difficulties in implementing bankruptcy law. It's going to take some time. If it had been done 10 years ago, we wouldn't even had these problems, frankly. And I want to stress that, because I must say the banking, I know I was on the board of 4 banks in my career in government, and it was always the fact that the legal processes were incredible. You couldn't. They always used to say, I used to ask them, why don't you prosecute? They said it will take 50 years and nothing will happen. Okay. So this bankruptcy law, whatever is failing, I think is going to be critical, and I hope they keep improving. And finally, on the very important issue which you have directly raised about credit, I think you have to make a start. As long as the government is willing to adapt and listen to people, that's very important. I've always found that they must be willing to listen to the people who are affected and adapt their policies. I think it's a good start. I think there's no harm in capitalizing the banks. For example, if you make sure that the ones which have more potential, which are slightly better managed, whether it's SPI or whatever, versus those who are very badly managed and who are in dire straits, the former get more of those funds, the latter get etc. They haven't announced this, but I hope if they listen to people and do it accordingly, that would be a good positive for the future.
Sure, sure. Ajit, Ranade, you know, as far as the finance minister, the finance secretary and everyone else has been talking about, 8% growth for the Indian economy in 2018. Do you see us achieving that kind of growth, and what is it that we need to do to, to push the economy to the next level?
Well, we at least have now started on an upward trajectory. The July to September quarter, as you know, the GDP growth has gone up finally after declining successively for almost 5 quarters. So if that trend continues for the next 3 or 4 quarters, we can get closer to 8%, but to get a sustained 8% growth, I think we'll have to wait into probably the following year because of 2 or 3 things. One is that we definitely need a big driver of growth is private sector investment, that is investment to GDP ratio, which Mr. Arun just mentioned. It is barely 27% now. It needs to climb up to at least 30, if not 34%. And for that, you need to have strong investment sentiment, strong business sentiment, strong consumer confidence. Secondly, industrial growth in India is not possible on a sustained basis without exports also doing well. So our export sector, which exports as a proportion of GDP is almost 18-19%. They have been very lackluster. They have not been growing at the rates that we have seen in the past, near 15 to 20%. So they are also thankfully in a slightly upward trajectory, but we need to grow our exports by at least 10 to 15% on a sustained basis. And the prospects for that are good because the world economy, the outlook for the world economy first time after 6 years is actually is very strong. I mean, in a synchronized way, North America, Europe, Japan, China, East Asia, the projections for all these economies according to the IMF have been revised upwards. So in such a scenario, I think the prospects for India's exports to do well are good. So if we capitalize on these two with a normal agriculture and with a normal monsoon, I think it's possible. See, to get to 8%, we need to first improve our potential GDP growth rate, which I think had fallen. So we need to, so that we don't overheat. So we need to do it in a sustained way. But I think it's definitely possible. Towards the end of 2018, we should be hitting closer to 8%. Okay,
all right. Ajit, Ranade, thank you for joining us on the program and sharing your perspectives. I'm going to continue the discussion here with our guests in the studio. TK Arun, investments in 2017 have been a major concern for us. Do you believe that is going to be a concern going forward as well? And what corrective measures should be taken?
The government has said that it will start some public investment programs, the Bharat Mala road network, etc. Railways will also step up. The joint venture companies it formed, they are getting ready to invest, and I'm sure that investment will see some. Once the government invests and that investment translates into additional demand, then you will see private industry also coming in and investing in increasing their capacity. But if you want serious pickup in investment, you have to have private parties coming into infrastructure. Of that, we don't currently have a framework in which it can be done sustainably. Over the last 10 years, 13 years, till 2011 end actually, when the UPA government promoted public-private partnership in a major fashion, that is when we saw a huge pickup in infrastructure investment. But the way we went about this and the kind of contracts that we entered into with the private sector, they had some shortcomings. And the companies entered financial closure without actually having obtained all the clearances and without having forward visibility on the acquisition of necessary land. These all created problems for these companies later. So I'm optimistic that as India urbanizes and we are forced to build the urban infrastructure a fast-growing economy necessarily needs, we will see a pickup in our overall investment as a proportion of GDP, that investment rate. However, unless your banking sector is able to finance that investment, it will be difficult to move forward. And for that, we need these reforms, not only in terms of recapitalization, but in structural reforms in how banking is done. The incentives for a banker must be right. Right now, bankers actually have an incentive to do nothing in the public sector. They get their salary, they get their retirement benefits, etc. The only way to change this is to completely overhaul the remuneration structure of our bankers. They must be properly aligned with the market. And I think ideally bankers should have a three-tiered remuneration structure. A small component of fixed income, a variable component mixed to medium-term performance, and the largest component linked to long-term performance, which is subject to clawback in case there is a failure in the loans that they have originated subsequently. If this kind of a structure is established and bankers in the public sector are remunerated as handsomely as the counterparts in the private sector, I don't see a reason why our banks should behave perversely.
Sure.
And this reform is very crucial.
I'm just coming to you, Dr. Virmani, but before that, let me introduce Alok Churiwala, Managing Director, Churiwala Securities Private Limited on the program. Thank you for joining us and welcome to the program. I'm just coming to you before that, Dr. Virmani. Yeah.
So, on investment, there are two things. One, I broadly agree with what TK has said, but I want to raise one other issue. If you look at the investment decline over the last 5 years, most of it, if I remember correctly, something over 90% of it has come from a decline in household investment in structures, what they call, which is basically residential offices, etc., done by household enterprises and individuals. So there are two, in my analysis, there are two important reasons for this. One was the very high real interest rates, and the second was this whole NPA problem. So clearly, I am completely on agreement that if you can, the bankruptcy law, etc., if you solve this NPA problem in the banks, that will certainly go a long way. And given that inflation is kind of risen, the real interest rates in a way are now not that much of a problem as they were for the last 2, 3, 4 years. So if inflation goes back to 4-5%, that real interest rate will not be such a serious problem, though I would still like a looser monetary policy. So that is one. The second, just to add to what he is saying, I think the key as far as the government is concerned is this shift, long-term shift from what we call government consumption expenditures to government investment. The government has repeatedly promised over the last 2-3 years, which is good, which is the positive, but they have not been successfully able to implement it yet. For example, in the last budget, I think they talked about 30% increase in capital expenditures, right? So hopefully, we all must hope that they are able to spend more on public good investment like Sagarmala, etc., as TK has mentioned, and that will have a big transformative effect. Yeah.
Talking about the budgets, we'll discuss what we expect from the budget in just a bit. But before that, Alok Churiwala first. What have been the how has the year been for the markets in 2017, and what can we expect for 2018?
So, I think 2017 is going to be remembered as a very pleasant year for the Indian investor. Lots of, IPOs, the primary market has been very active. Even as far as secondary market is concerned, the year has been characterized by a lot of inflows through the SIP route in mutual funds. And largely, it's been a buoyant year. It's a year in which investors have made money, and it's going to be remembered pleasantly by the investors for a long, long time.
And as far as 2018 is concerned, what can we expect? What can we expect for the future in 2018?
2018 is going to be slightly different ball game. I don't know whether we'll be able to, carry on the same momentum that we've seen. Two things. One is the fact that we are going to be faced with a budget that could be, slightly populist in nature, and markets, for one, don't like, doses of populism, as it were. So that's one part of the story. But the other part of the story could be that with GST hopefully having settled down in early 2018, we might see, growth increase and things come to a little normal. Because also we must remember, and we must cut back to 2017 for one moment, that this was the year that saw perhaps two of the biggest reform moves. The demonetization, arguably, whether it has given benefit or not is one part, and of course implementation of GST.
Sure.
So 2018 is going to be interesting, may not show the same kind of momentum, except earnings of companies may certainly increase.
Right. Okay. TK Arun, as far as the budget is concerned, what are your expectations, and do you think that it's going to be a populist budget?
Before the budget, can I just say something about the market?
Sure.
This year, we have seen stock prices climb even as corporate performance deteriorated, which means your price earning ratio has been steadily going up.
Yes.
You had a slew of public issues. Companies were able to raise money from the primary market, which is good. But the price they offered was something like a price earning ratio of 32, 62, 72. I don't know how these prices are justified. Might end up people being taken for a ride, having paid excessive prices for the shares they're getting. And this has been fueled by easy money all over the world. And carry trade exists, in which you raise money in Japan at very low rates of interest of 1% or less, bring it to India, and you reap the higher margins available in the Indian market, and the rupee being holding steady, even absolutely an easy ride for them. That liquidity in turn fuels the stock price rise. Plus, household savings for the first time has been lowest in fixed deposit this year, because people are worried they are not earning enough on their fixed deposits, and they put money into mutual funds, which in turn have fueled the market rally. This clearly is not sustainable. To have a Sensex with a PE ratio of close to 25 is not a sustainable thing. So which means that in the period to come, when successive rounds of rate hikes by the US Fed take place, it might see some money leaving India, and you will see some kind of correction. The Indian economy is basically sound, but the stock market's current performance is out of line with the reality.
Okay.
About the budget, we are entering that year of the election cycle where governments necessarily become slightly large-hearted towards the public when it comes to the last year, when they have to meet their electoral promises, as well as to allure the voters with whatever they have to offer. This reduction in the corporate tax rate to 25%. So next year is the budget when they have this opportunity to realize that. Plus, you will see some government spending schemes which will hopefully, they hope will persuade the voters to vote for them.
Sure.
You have elections in Karnataka and
several
Tripura.
states. Several states. I think there's Chhattisgarh, there's Madhya Pradesh as well.
Rajasthan, Chhattisgarh and Madhya Pradesh close to December. Then of course, then we are going to May, the general election.
Yeah. Dr. Virmani has a smile on his face.
So
tell us.
On the stock part, I disagree on half of it and agree on half. The part where I agree is what I have been talking about for last 18 months, that our monetary policy is too tight, the interest rates are too high, and therefore it's bringing in and carry trade. In fact, in one of my tweets, I was the first to mention this carry trade problem for the first time in India. So that part is correct, but it turns out that the recent performance of the stock market is due to money coming from domestic savers. Domestic savers have been actually out of the market for a long time. Now, exactly the date I don't know, but over the last 6 months or so, they have come into the market. That I think is a positive and sustainable one. Why? Because it's partly due to this pressure which is being put on black money, on savings in gold, land, etc., etc. So I think that is more sustainable. The first part I agree completely with what TK is saying, but I think the second part is a positive element. One of the few, again, I have been I have pointed out the problems of demonetization, but I think some of this is a long-term effect of that. The next part, your main question on the budget is that really, every government at some point or the other does some giveaway. So my criteria I have is of government does 10-15% out of the total, I am not unhappy. If they go above 30 and to 50% and all, then it's a disaster and I will criticize. you know, 10-15% if they do, I will just ignore.
Because
every
part and parcel
government
of the
has
game.
done it.
It's a part and parcel of the game.
It's like 70 years every time they have done it. So it's the question of extent we should be discussing. Okay, but on the other side, clearly there is a huge pressure, and you know, as many people have political economy. I'm not a political economist,
sure,
but many people have pointed out that they have harmed. Many of these policies have harmed their own interest group, you know, traders, etc., etc. So I would be not at all surprised if they do something specifically to get that part of the thing back. So there are
sure,
two criteria I would use. Is it efficient way of doing it in the part of a general reform, or is it giveaways? And if the giveaways, are they big, 10-15%?
Okay, all right. Final closing comment from Alok Churiwala on what you expect from the budget.
So, largely, you know, we believe in if it's not broken, don't fix it. Things are going well as far as stock markets are concerned. While there is always hope for, you know, introducing Section 88E, bringing that back, so that the, you know, ill effect of securities transaction tax, which is actually hurting a lot of traders, that can be mitigated to a large extent without having too much impact on revenues. Also, you know, there has been some talk of tinkering with capital gains. I think it is best left untouched as of now, primarily because it's election year, and also we have to remain competitive as far as the rest of the ecosystem in Singapore, Hong Kong, and all that is concerned.
Sure.
So, you know, I think, like I said, it's going to be a populist budget. They're not really going to try too many things. So let's wait and watch for the D-Day.
Okay, all right. On that note, then we'll have to call it a wrap on this edition of Policy Watch. Alok Churiwala, TK Arun, Arvind Virmani, thank you so much, gentlemen, for joining me on the program and putting things into perspective for us. That's it from me. See you again next time.